Hello and welcome to Exchange Traded People. I'm your host, Michael O'Riordan, and today's guest is Anil Ghelani, Head of Passive Investments and Products at DSP Mutual Fund in India. Anil, welcome to the show.
Hi, Mike. Great to be along with you over here today.
Super. So Anil, I kind of like to split these conversations into two parts. The first part to talk about you and your story, so people get a handle for who you are and how you've kind of gotten into the seat that you are today, to talking about your career and stuff like that. And then the second part to talk a little bit about the market and specifically about the Indian market, because for a lot of the listeners here, it's probably a market that they're not that familiar with. So kind of doing a little bit of a deep dive into that, I think would be very interesting for a lot of people. So speaking of deep dives, like if I dive straight in, my first question to you is, when you were a kid, what did you want to be when you grew up?
As a growing kid, I used to look for logic behind everything, focus on analysis of what is happening, how and why.
Oh, really?
And
that's very mature.
Well, I mean, if I would say, it was a typical wiring that what one would define as like a left brain type of a person, you know.
Right.
That is what I meant to say. Not exactly like doing analysis, but what I mean is that looking for some rationale, some logic behind what is happening and why, basically.
Yep.
So that typical wiring in mind, that okay, I think this way, and so maybe finance and accounts sort of came naturally to me.
Gotcha.
So not as a very young kid, but as a slightly growing up kid, I had thought something I want to do in this field of finance and accounts, and hence in India, where I grew up in Mumbai, becoming a CA or chartered accountant was considered as a great career choice. So I thought that yes, maybe this is where I would like to build my career in, or maybe
Gotcha.
become a chartered accountant when I grow up.
I'm sure that must have made your parents happy.
Oh, absolutely, because it's one of the very well-respected profession in India and many parts of the world.
So how did you kind of make your start in your career, and kind of talk us through the journey to to what you do today?
So like I said, with that approach, I did go ahead and get my chartered accountant qualification, and that led me to being in the field of taxation, auditing, assurance, and connecting the dots between the company financial statements and before the company financial statements are reviewed and analyzed by portfolio managers or research analysts, the work that goes on before that.
Right.
I worked in that field for a couple of years. I was working in those days with one of the big four companies, global consultant firms, consultant auditing firms. And from there, at one stage, I decided to make a career pivot and move into asset management.
Right.
So in those days in India, this I'm talking about early 2000s, the asset management industry had recently opened up for the private sector players to start functioning and doing business. So I thought to my mind that it could be good to grow with a growing industry segment.
Yep.
Because many companies were setting up shop. Some were local players, some were global entities, some were joint ventures between local and global players. But it seemed very dynamically growing segment of the industry. In some way, because I was doing the audits of many of the companies who were in this business of asset management, stockbroking, insurance. So I was watching the business dynamics of that industry growing very rapidly. And hence I thought, let me take a shift and move into the field of asset management. So that's what got me to the money management field. And then I transitioned from there into multiple roles to come into this role of managing passive funds and ETFs specifically.
Got it. Because you've been at DSP for a very long time now. So I guess the question, like, why have you why have you stayed there so long, and sort of like what have you been doing in all those years there?
Great question. And I do keep getting that very often, that you are in the same company for more than 20 years. So what exactly are you doing? So like I mentioned, Mike, I was part of accounting function doing auditing assurance type business. So when I joined money management, just because I, as an individual, Anil Ghelani, want to pivot and do portfolio management or research analysis, does not mean that the company is going to offer me that role.
Yeah.
We need to showcase some value addition or something which we can bring on the table for the company to hire us. So when I joined asset management business, coming from a audit assurance background, I said maybe I can do good support function, control function linked to, let's say, fund accounting, fund administration, valuation of securities. So I joined in 2003 at DSP in that function. Then I realized that to move closer, I'll have to possibly do further knowledge enhancement. So I started pursuing the CFA program.
Yeah.
That helped me gain more relevant knowledge, gave me a better understanding of the drivers of risk and returns of different asset classes. And it helped me to gradually make a career pivot from back office fund accounting to a role which was into a middle office, gradually, which led to doing credit research role, meeting company management, analyzing company balance sheets. Then it gradually led me to doing a role which was into a larger picture role of managing our one entity, which was a pension fund management company. I got the opportunity to be the CEO of that particular company and the chief investment officer. And after that, more recently, since the past about 7-8 years, as we were seeing a very fast growing trend in the ETF and index funds in India, we decided to set up this vertical, and I've moved here to grow and build that particular business vertical. So structurally over these 22 years, thereabouts, I've shifted to 4 distinct roles that ensured a good learning curve. At the same time, the understanding of one role helped in the other in giving a holistic picture to whatever I'm doing right now, you know. So coming back to the very first question, and where I'd mentioned that I used to think that I'm a sort of left brain guy. I just wanted to clarify to all the friends who are listening to us today that over the years, I've realized that maybe, yes, it is scientific and maybe there is some logic behind that also, that when you think of a left brain person versus right brain person. But I feel over the period, especially in our business of money management, wealth management, it's very important to have both the left brain and right brain. So you need to have both logical and creative approaches to be able to be really successful in this field of business.
Absolutely, yeah, absolutely. So you said you've been at DSP for 20 odd years. So when you kind of sit there now talking to me and you look back at your career, what are the kind of the learnings that you've taken from your career to date, and what advice would you give your younger self now?
In my opinion, the one big thing which I would advise many young professionals is to be little bit open to experiment new markets. For me, I got an opportunity to experiment new fields or new business verticals, but I never took the initiative to go to some global market. So back in the day, we were a joint venture with a large asset management company. Erstwhile, our company was known as DSP Merrill Lynch. Then it was a joint venture with another global entity, so it was called DSP BlackRock. So for a long period of time, we had a joint venture presence of some of the larger global franchise. And due to certain reasons, I always thought that it's better to be in my home country, better to work in India. But on a hindsight, to your specific question, that what advice or learning you would give to a young professional, is that if she or he is getting an opportunity to go and work in some other country or in some other region, then definitely one should consider that, because it can add a lot of different perspective to doing business. It can add a different perspective to recognizing people and being able to work with people in different areas in a better way. I did that in a very small way. I had gone for short-term assignments at the most of about 6 weeks. I worked in London office. I worked short assignment in Japan office. We had a lot of engagements that way, but I never really rebased my role from Mumbai and India to, let's say, Japan or London or New York or some other continent or country. Maybe on a hindsight, if that would have been done, I would have had a little bit broader perspective of but that's just a learning on a hindsight.
And talking about like traveling and working in different countries, like it was something you kind of like never really, the appeal of like working in London or New York or wherever it was, that never really kind of interested you. You were happy staying in India.
So Mike, in those days or even today, the logic that I was using is that India is a growth market. We are seeing a very nascent capital market as well as a fairly nascent asset management industry, which I belong to. So why should I think of moving to some other market which is already much more evolved? Rather than that,
good logic.
I mean, better to grow in a growing ecosystem.
Yes.
So I don't really repent that decision of not going in some other market. But if in theory I have to explain or give a learning to a new professional who is currently in Indian capital markets and at the start of their career, then I would definitely feel that, yes, that is one particular advice that I would like to share, that if you get a good opportunity to move across countries or continents, irrespective of whether that is a growth market or already a very grown, developed market, definitely you should think about it.
I think it's like as an individual, you grow a lot when you move countries, different culture, different people. It's a good learning experience for individuals, right?
That's absolutely right.
If there was one improvement you could make to yourself, what would it be?
Well, I think in terms of improvement, I would feel that at some point of time, we tend to stop our structured learning. What I mean by that is that we learn every day in our day job. We learn by meeting clients. We learn by seeing what markets did today and implementing that in our work. We learn by reading books. We learn by attending conferences. That is an ongoing thing. However, I feel that we need to constantly supplement that with some kind of a structured learning on a periodic basis. So for me, my last so-called structured learning happened way back in maybe 2006-07, when I completed my CFA program and got my CFA charter. And after that, I relied on my own self-learning, attending events, conferences, webinars, reading books, on-the-job learning. So I'm very keen to make that one shift, that once in, let's say, a decade at least, maybe once in 5, 7 years, 10 years, irrespective of whichever focus within the industry network you are, there will always be some good such structured learning. So for example, right now I'm very seriously evaluating to take up the CMT program, that is a focused knowledge on technical analysis.
Right.
And I feel, along with my existing knowledge of the industry that I work with, along with my CFA program based knowledge and my alignment currently to the passive investments industry, the ETFs and index funds industry segment, definitely having a further structured knowledge. That's the key difference I'm saying. Today, I can feel I have a large number of years of practical knowledge of seeing some charts and making my own technical analysis, and I do it every day, and I share it with some colleagues and clients. Fine, okay, that's a good thing you do, but if that is supplemented with a structured learning, then I think it can be very valuable. That is how I would look at it.
No, that's a very good point. Very good point. So we've talked about kind of DSP, being there a long time. So for people who are not familiar with who DSP is and what they do, can you explain?
Sure. Well, who DSP is even more very old story. So DSP is a family-run business which has about more than 160 years legacy in Indian capital markets.
Wow.
Our current chairperson, Aditi Kothari Desai, she is the 5th generation. So her great grandfather or great grandfather, they were the founding members and first directors of the Bombay Stock Exchange, which is Asia's oldest stock exchange.
Right.
So the DSP group or that particular franchise bears a testimony of being there for so many generations in the financial services industry and being at the forefront of a lot of developments in the ecosystem and industry network.
Yeah.
And currently the focus for the DSP group is into money management, doing the right thing, creating the right set of products, well diversified mix across active funds, passive funds, alternative assets, etc. So that's how the focus has been. And in today's world where we see so many cycles of companies growing and then disappearing, to be present for such a long period of 160 years, the one focus which I have seen in my 20 plus years with the DSP group is that always the focus is on putting ethics over profits. So that always ensures that there is a trust, there is a focus of putting investors first.
Yeah.
And that ensures that even when me or any of my other colleague who is associated with the company in the form of an employee, we feel that sense of ownership and the sense of comfort that yes, I'm doing the right thing.
Doing the right thing.
So there's a higher level of comfort in doing whatever we do.
Very good. Very good. So talking about kind of ETFs in industry, or ETFs in India. So like for people who kind of like who are again not familiar with the market, so ETFs have kind of grown massively in India over the past couple of years. Can you kind of like talk us as to like what's going on in India in relation to ETFs, why they've been growing so successfully, and what's been the appeal from local investors regarding ETFs?
Oh, absolutely right, Mike. I think over the past decade, I would say from 2014-15 onwards, we have seen a very sharp increase in the AUM, assets under management, for the ETFs. One of the main driver during 2014-15 was that our government administered provident fund, which is known as the EPFO, they started allocating small amount to equities as an asset class, and they chose the route of doing that through passively managed ETFs.
Right.
So that resulted into a good amount of capital flowing into the ETFs, and it also resulted in little bit increased awareness amongst the retail people at large, because anybody and everybody who is a salaried employee, they were indirectly becoming an investor into ETF, because every month some component of your salary is getting deducted and going to the EPFO, who in turn is investing into the ETF.
Right.
So that was one structural change which came across. Mind you, this was not like a government corpus being invested. It was a pool of money of various salaried employees, which was running as a government administered provident fund from which the money was being deployed. So that was a subtle difference. And on the back of that, then gradually there was increased interest, awareness about ETFs and index funds in general. I feel one more thing which happened later on was disinvestment by the government of India of certain state-owned entities, or what in India we call as PSU, public sector undertakings. They were bundled up into a particular ETF and launched for retail investors, retail, institutional, anybody who would be keen to invest into that. So that also led to a lot of brand marketing, advertisement, and positioning of that ETF to retail investors as a good diversified way to own these PSU companies. So that helped a lot in terms of increasing the awareness of ETFs. So that I would say, laid down one foundation. However, very interesting shift might came across just 4-5 years back during the pandemic, or I would say post-pandemic, where opening of demat accounts and trading accounts to buy ETFs and all became very simplified and digital.
Right. Yeah.
Just by doing one left swipe and right swipe, you could open a account and start investing. So we, like, if without going into very detailed numbers, but if I just compare the total number of ETF folios as at end of March 2020, when the peak of the pandemic started, and let's say March 2025, the number of folios, means retail accounts, has grown by about 60% CAGR, compounded annualized growth rate, over the 5 years. So massive
60%. Wow.
60% CAGR in terms of the number of folios. So it would be almost around, like, year on year compounded growth. So large number of growth. And
Huge
likewise
growth.
for index funds also. So whenever I'm talking about this, it's combination of both ETF and index funds. Index funds saw around 90% CAGR growth,
Wow,
over the period. The AUM, assets under management, still is larger for ETF and smaller for index funds. But still, I'm just saying, in terms of just the retail accounts, they grew sharply in this last 5 years. So I feel that going forward, these are the kind of drivers which will be very important to watch for, that after now such a large number of investors have taken interest, how to grow it further, offer more ideas, more innovative products.
Do you see, like, the kind of let's call it the battle between ETFs and index funds? Is it kind of like 50-50 at the moment, or are there, like, which is more popular?
I think both give a similar risk return outcome to the investor. It just depends on the route that you want to take. ETF and index fund, if the underlying is same, will deliver pretty much similar outcome. In India, still there are a large number of investors who are not having a broking account or a stock broking account and a dematerialized account. So for them, index fund still does make sense, and hence, like, when I mentioned about the number of folios growing, the growth in index fund number of folios is much more sharper and faster as compared to the ETFs. But yes, I think incrementally the focus could be split 50-50, because though less, but still many people are setting up broking accounts, internet connectivity on smartphones and mobile apps being offered by stockbrokers are increasing. So definitely ETFs are increasing. But if you ask me personally, I feel that the simplicity which index fund offers, is little bit taken away in an ETF, because while today, Mike, you and me, or most of the friends listening to this podcast, are part of the capital market ecosystem. We understand the concept of bid offer spread. We understand the concept of delivery, cash flow. Whereas many retail individuals, or just think of it, Mike, even like a colleague working in my company who is part of, let's say, human resources function, or who is part of marketing function, she or he might not be so comfortable with getting a sense of, whether what is the indicative I know, and whether the bid offer spreads are reasonable, and whether I should buy at this level or something. So it will take time, and that's what our job is as professionals, to gradually increase that awareness and give a good platform. So I feel both will grow gradually, but for a simplicity's sake only, I feel index funds are important part of the ecosystem.
And just kind of like zooming out a little bit, the asset management industry as a whole in India, is it still dominated by, like, active mutual funds versus passive investing?
Oh yes, it is definitely. So as of today, passive mutual funds and by that I mean both combined, index funds and ETFs both put together,
Yeah.
would be about 16 to 17% of the total
17%.
assets
Right.
under management.
Okay.
Within that, for equities as an asset class, that number would be slightly higher, like equity ETFs and index funds as a percentage of total equity AUM would be about, I would say, 22-23%. But still, overall, it is small. Let's say if I compare that with the number in the US, it has crossed 50% now, basically, already from last year, whereby passive funds are larger in size as compared to active funds. But I feel that also happened over the time, right? Over the last decade, I remember very distinctly, 2013 was the first year in the US mutual fund industry when passive mutual funds saw slightly higher net inflow as compared to active mutual funds. Both saw net inflows. So it is a little bit talk of the town that, oh, passive funds are seeing higher inflow.
Yeah.
After few years, in fact, active funds stopped seeing new inflows and only passive funds were seeing inflows. So that took 1 decade from 2013 to maybe 23, 24 for the total size to gradually cross over the 50%. Well, I guess in India, maybe we are still getting there, basically. You know, I don't think.
Do you see that kind of like, you know, as with like all the other markets across the world, you know, that tilt in the balance is kind of shifting more towards the passive ETF kind of wrapper versus the mutual fund wrapper? Ultimately, you see the same kind of direction happening in India over the course of time?
Do you mean active ETFs?
No, I mean like the kind of like active mutual funds versus passive index funds or ETFs.
Yeah, so that shift is gradually happening, but to be very honest, don't see it happening as much as what we have seen in the US, whereby it will cross 50%, because the drivers for the US market, which are a little bit tax benefit, etc., are not there in India. Point number one.
Yeah.
Point number two, like I mentioned, there is a general belief that in the US, generating alpha or outperforming the index is very, very challenging.
Yeah.
And hence that is one of the big driver for the shift. Whereas in India, I feel still, if you are a good manager, active manager, there are potential opportunities to generate alpha and outperform the benchmark.
Right.
Of course, there will be cycles. So we very closely track what we call as the cross-sectional volatility.
Yeah.
So whenever the cross-sectional volatility in the local market is high, during those periods, active managers will definitely get an opportunity to outperform the index in a much more better way. And there, like 2 years back, there was a period when cross-sectional volatility was very narrow. So it was being very difficult to outperform the index. So I feel this cycle will keep coming and going. If you are a good manager, following a good, robust framework of analyzing companies and sizing your portfolio well, and taking bets which are deliberate, diversified, and suitably scaled, definitely as an active manager in India, you will get good opportunities to outperform. I don't think that it will be very soon,
It'll take time. Yeah.
It will take time. Though in number of investors, it will grow fast, I believe, because let's say new to mutual fund investor, for him or her to get started, maybe a simple low cost index fund would be easiest sell. That okay, come invest here. So you are able to relate to the concept of equity as an asset class, or commodity as an asset class, or bonds as an asset class, and then don't worry about the divergence of performance or active allocation. Gradually you get familiar, comfortable, and then transition. So that I think will definitely be there.
Yeah. So where do you see the opportunities for future growth of ETFs in India? Is it kind of like the retail channel, you know, the people, you know, as you said, swiping left and right using kind of like apps and digital technology? Is that where the growth is for ETFs?
I think, Mike, like I said, the number of investors growth will come from that retail.
Yep.
In terms of size of assets under management, it will still be possibly slightly larger HNIs, ultra high net worth individuals, large family offices who are conscious of cost, who are conscious of changing managers, and hence, wary of the concept of star fund manager versus a star process or a star rule. So for example, in my local markets in India, I, as Anil Ghelani, I am never known as Anil Ghelani is a star fund manager managing so many ETFs and index funds at DSP. Fine, okay. Anil is there managing funds in a robust process and making sure I am being serviced well and making sure my funds have low tracking error and tracking difference. But if tomorrow Mr. X or Miss Y as that particular fund manager changes, that investor is never going to
know,
really suffer, or is not even possibly going to know, because that robust process is set in place, and it will be more comfortable. So I think that is one of the main reason why even HNI's family offices are shifting gradually. So that's where the larger ticket size AUM will shift possibly, and in terms of number, the shift will be more from the retail and the mass new to investing people.
Got it. The ETF market in India, like just looking at the kind of the players and the participants, it's very much a domestic market in terms of like domestic issuers, domestic players. Do you see opportunities for like international ETF managers come to India?
Well, I think in India we already have a good mix of global players as well. Like some of them are present in India as an individual entity, some present as a joint venture with local players. Some of it is public information, but I don't want to take specific names, but I'm just saying, like, for example, a large Japanese domiciled entity has a huge presence in India, and they are amongst one of the top 3 ETF managers.
Right.
Likewise, I mean, there are many such players. A large Korea domiciled entity who has a presence in India, and they are amongst the not the largest, but amongst the top 10-15 players managing ETFs. So today in India, one of the largest player with the largest AUM of ETFs is a joint venture by one very large local India domiciled bank and a global joint venture player who has a sort of like joint venture. So I believe for any new, so I believe if any of the friends who are listening to your show today, Mike, and who are not present in India, if they are thinking that, hey, what's going on in the India passive industry and should I set up shop? Well, most certainly I feel it could be a great opportunity. And in case if that particular player is in a position to have the wherewithal to set up shop on their own as a standalone entity, then also Indian regulations permit 100% global presence in asset management industry. So that is permissible and they can set up shop. If they feel that maybe it could be prudent to do a joint venture, not just for the capital or capex, but just for having the know-how and the connectivity of the market and distribution presence, then that also could be a very prudent and a very logical decision to get started into the Indian asset management industry. In short, for a global player looking at India, I believe the next 10 to 15 years are going to be very sharp and very robust growth for wealth management and asset management. So most certainly it makes sense to be present in India, either as a, depending on your DNA and your permissions, as either a standalone entity having a serious focus in the business, or as a joint venture with a suitable like-minded business partner.
Now there's definitely opportunity there for sure. All right, so like imagine that you're retired. You've done your thing. You've like money is no object to you anymore. So basically the question is, if you weren't doing what you do now, like what would you do?
Well, that's a great question, Mike. And to be very honest, I have a very good plan in mind. I don't know how and when I will be able to implement that. So, like you said, that my current job is involved in managing money for investors, and my goal or my aim is to help my investors to achieve their financial goals linked to their life goals. So in our Indian culture, we have a goddess of wealth, a goddess Lakshmi, we call. So I am linked to working in that field.
Right.
Subsequently, let's say after a couple of years in future, I am very keen to be linked to or associated with some work relating to another very important goddess we call goddess Saraswati. Saraswati Mata or Saraswati goddess is focused on knowledge, education, learning. So I'm very keen to be in some such field whereby, not in a very big monetary way, but in a big way, if I can touch the lives of people by helping them gain knowledge enhancement, skill specific development, to maybe it could be skills relating to financial markets, because that's where my focus area or my learning has been. That's something which I'm trying to start thinking about, that okay, maybe a couple of years or a decade or two later, when I'm looking to realign my focus area, that is something which I would like to be doing. And maybe it can be something linked to, by that time, technology and education, so some ed tech related setup or something where I can in person be there. That part I have to yet figure it out, what exactly it would be, but I'm pretty sure that I wanted something to be linked with knowledge enhancement and development, which can benefit larger set of people.
Kind of like giving back to people, right? Sharing your years of experience with others. Yeah.
Absolutely,
very good.
Absolutely, yeah.
Very noble. All right, Anil, this has been a great conversation. Thank you so much for your time. Thanks for telling us all about the Indian market. It's fascinating, and I'm sure anybody listening to this will have learned a ton. So thank you.
No, thank you very much, Mike. And I think the work that you are doing at Mula Invest and the Mula Foundation is amazing. The focus is to increase the awareness and financial literacy and spreading the right set of knowledge. So I think that's something great. And in whatever you are doing, I'm so happy I could be a small part of that to help amplify that particular voice. So thank you very much for having me.
Thanks, Anil. Thanks.